Is the banking system on the edge of disaster? The Fed's shocking admission reveals the imminent collapse that could change everything. Hello everyone, in today's video, we're diving into a crucial topic, the current state of the banking system. Startlingly, the Federal Reserve, the Fed, has recently made concerning admissions about the system's stability. In a speech last month, Fed Chairman Jerome Powell said that the banking system is on the verge of collapsing. He went on to say that if we don't take action soon, the entire system could come crashing down. This is obviously very alarming news. So, what's going on? Why is the Fed so worried about the banking system? Let's find out. The history of banking crisis. Banking crises have a long history. The first recorded banking crisis occurred in 1637, when the Dutch tulip bubble burst. Since then, there have been many other banking crises, including the Panic of 1873, the Great Depression, and the financial crisis of 2008. Each banking crisis has its own unique causes, but they all share some common features. In most cases, banking crises are caused by a combination of factors, such as excessive lending, asset bubbles, and regulatory failures. What is the Federal Reserve? The Federal Reserve is the central bank of the United States. It's responsible for regulating the banking system and maintaining financial stability. The Fed was created in 1913 in response to the financial crisis of 1907. The goal of the Fed was to prevent future financial crises by providing a lender of last resort to banks and by regulating the money supply. Why are banks on the verge of collapsing? There are a number of reasons why banks are on the verge of collapsing. These include 1. The high level of debt in the U.S. economy. The United States has a staggering amount of debt, both at the government and individual levels. This debt burden puts immense strain on the banking system, making it vulnerable to collapse. 2. The low interest rates that have been in place for many years. To stimulate economic growth, central banks have maintained low interest rates for an extended period. While this policy may encourage borrowing, it also increases the risk of financial instability and a potential collapse of the banking system. 3. The growing number of defaults on mortgages and other loans. With increasing economic uncertainty, many borrowers are struggling to repay their loans, leading to a rise in defaults. This puts significant pressure on banks' balance sheets and can ultimately lead to their collapse. 4. The increasing risk of a recession. The global economy is facing various challenges, including trade tensions, geopolitical uncertainties, and the impact of the ongoing COVID-19 pandemic. These factors contribute to an elevated risk of a recession, which would severely impact banks and potentially push them toward collapse. What are the consequences of a bank collapse? A bank collapse would have a devastating impact on the U.S. economy. It would lead to a loss of confidence in the financial system, which would cause people to withdraw their money from banks. This would lead to a liquidity crisis, which would make it difficult for businesses to get loans. A bank collapse would also lead to a decline in economic activity. Businesses would have less money to invest, which would lead to job losses and a decline in consumer spending. The Fed's solution. The Fed's solution to this problem is to print more money. This will allow banks to lend more money without having to worry about running out of cash. However, printing more money is not a sustainable solution. It will lead to inflation, and it will devalue the dollar. This will make it harder for Americans to afford goods and services, and it will make it harder for businesses to compete in the global economy. What can we do to prevent a bank collapse? There are a number of things that we can do to prevent a bank collapse. These include 1. Reducing the level of debt in the U.S. economy. Reducing the level of debt in the U.S. economy is essential to ensure financial stability. Excessive debt poses risks to both individuals and the overall economy. It requires implementing measures such as responsible borrowing practices, promoting financial literacy, and encouraging fiscal responsibility. Government initiatives, including debt reduction programs, can help individuals and businesses manage their debts effectively. By reducing debt burdens, we can alleviate the strain on the banking system, mitigate the risk of default, and create a healthier economic environment for sustainable growth. 2. Raising interest rates. Raising interest rates is a strategy used to stabilize the banking system and prevent excessive borrowing. When interest rates are increased, it becomes more expensive to borrow money, which encourages individuals and businesses to be more cautious with their borrowing decisions. Higher interest rates also incentivize saving, as the returns on savings accounts and investments increase. By raising interest rates, central banks can effectively manage inflation, curb risky lending practices, and promote long-term financial stability. However, it's crucial to strike a balance, as excessively high interest rates can hinder economic growth and affordability. The timing and magnitude of interest rate adjustments require careful consideration to ensure a well-functioning banking system and a healthy economy. 3. Tightening regulations on the banking system. Tightening regulations on the banking system is crucial to prevent excessive risk-taking and ensure the stability of financial institutions. Robust regulations can promote transparency, accountability, and prudent risk management practices within the banking sector. Measures such as stress tests, capital requirements, and improved oversight can help identify vulnerabilities and prevent systemic risks. Additionally, regulations can address issues like conflicts of interest, market manipulation, and unethical practices. By implementing tighter regulations, authorities can enhance the resilience of the banking system, protect consumers, and mitigate the likelihood of future financial crises. Striking the right balance is essential to foster a healthy and trustworthy banking environment that supports sustainable economic growth. 4. Providing financial assistance to banks that are in trouble. In times of crisis, providing financial assistance to banks facing financial distress is a measure aimed at preventing their collapse and mitigating potential systemic risks. During times of crisis, governments and central banks may intervene by offering liquidity support or capital injections to troubled banks. This assistance helps stabilize the banking system, maintain public confidence, and prevent contagion effects. However, such aid should be accompanied by strict conditions, such as implementing restructuring plans, improving governance, and addressing underlying issues. Transparency and accountability are vital to ensure that taxpayer funds are used responsibly and that troubled banks undertake necessary reforms to regain stability. By providing targeted financial assistance, authorities can safeguard the overall financial system and promote a healthier banking sector. The state of the banking system demands our immediate attention and action. The Fed's reliance on unsustainable measures, such as printing more money, poses risks of inflation and economic instability. We must advocate for responsible financial practices, reducing debt, and implementing stricter regulations to fortify the banking sector. It's crucial to hold the Fed accountable and demand long-term solutions that prioritize stability. Stay informed, share this video with others, and engage in meaningful discussions. Together we can foster a more resilient and secure banking system. If you found this video informative, don't forget to hit the like button and subscribe to our channel for more insightful content. Thank you for watching and supporting our efforts towards financial awareness and stability.